Episode 12, Trade Management, the Art of Doing Less. Most traders don't lose money because of bad entries. They lose money after they're already right. They move stops too early. They take profits too fast. They protect trades that were never in danger. In this episode, we're going to talk about something most traders never master: trade management and the discipline of not interfering. Because once Harmonia gives you a valid entry, your biggest enemy is no longer the market. It's you. The hard truth. Here's the reality most traders don't want to hear. Your job is mostly over after entry. Once Harmonia gives you acceptance, structure, defined risk, your edge is already active. From that point forward, the trade doesn't need more thinking. It needs less emotion. Trade management is not about control. It's about restraint. Why most traders exit too early? Early exits almost never come from market logic. They come from fear. Usually one of three things: fear of giving it back, fear of being wrong after being right, fear of watching profit fluctuate. None of those are auction-based reasons. Harmonia already told you where price should go if the auction is functioning correctly. Your job is to let it try. Managing trades by auction state. Harmonia trade management is simple because it's state-based, not candle-based. We don't manage by feelings. We manage by where the auction is. 1. Acceptance phase. The 20% hold. Once price is accepted above or below 20%, expect pullbacks, rotation noise. This is normal. If price is holding above 20% and structure remains intact, the auction is healthy, the trade is alive. This is where most traders sabotage themselves. Do nothing here. Managing during acceptance usually means tightening stops too early, exiting on noise, confusing rotation with failure. Let the auction breathe. 2. Distribution phase. 20, 50, 80. This is where greed and fear show up together. Here are the rules. 50% is a decision point, not an automatic exit. 80% is a target, not a guarantee. What you can do: scale partials at 50%, trail stops only after structure confirms. Let runners exist without babysitting. What you don't do: exit because it feels high, short into strength without failure, tighten stops randomly. If the auction hasn't failed, don't act like it has. 3. Extremes. 80% to 100%. This is where management becomes protective, not aggressive. At extremes, continuation slows, failure risk increases, emotions spike. Valid options here take full profit, trail aggressively. Wait for failure before fading. What you never do: add new size, chase extensions. Assume reversals without evidence. Extremes are not invitations. They're warnings. The single biggest management mistake: moving your stop to break even too early. Break even feels safe, but it's emotional safety, not structural safety. If price hasn't completed distribution, broken structure, shown exhaustion, then break-even is just a premature exit disguised as discipline. Why letting winners run is misunderstood. Letting winners run does not mean ignoring structure, hoping, holding forever. It means letting the auction finish its job, exiting when the reason for entry no longer exists. Harmonia tells you when the auction is complete. Your job is to trust it. Your only real job while in a trade. Ask one question: has the auction invalidated my thesis? If the answer is no, stay in, stop watching every tick, stop negotiating with candles. If the answer is yes, exit immediately, no excuses, no reinterpretation. That's discipline. Flat is a position. One of the most powerful Harmonia skills is knowing when not to be in the market. After exhaustion, failed, continuation, heavy chop. Flat is not missing out. Flat is preserving clarity. Where confidence really comes from. Confidence doesn't come from entries. It comes from following your plan, not interfering, surviving randomness. When you manage trades correctly, you stop feeling rushed. That's when consistency shows up.